Hi, this is Joe Murphy, and the purpose of this video is to give you an overview of a loan book review system for credit unions in the Republic of Ireland. This is a Microsoft Excel based product that enables you to access the data in your own credit union system and then to analyze and report on it. The system is designed not only to comply with Section 35 regulations, which require a quarterly loan book review, but also to enable you to examine your loan book in a variety of different ways, thus giving very valuable management information and also giving your board the ammunition on which to judge the adequacy or otherwise of their bad debts provision. The Resolution 49 provisioning system is currently the benchmark in all credit unions in the Republic. On top of that, Section 35 regulations require that in the event of rescheduling, that various provisions are maintained or added to as the case may be. And indeed, some credit unions add to their Resolution 49 provision and enter adjustments onto their own systems. And the sum of those provisions becomes the minimum provision that can be applied to any loan. However, this system starts off and looks at each individual loan from a number of different aspects, one of which is the number of weeks that the loan is overdue, the number of days since the last capital repayment, and then there are various triggers such as have temporary arrangements been entered into, has there been share to loan transfers to look after the likes of arrears and interest on a loan, has the loan been referred to a solicitor, or indeed has there been correspondence with MABs or with a personal insolvency practitioner. And each of those items are trigger items that score a risk rating of 1 to 5, which equates to a provision of 20 to 100%. Now, most of the data is already on your credit union system, whether that be Wellington, Nottingham, Progress, ICE, Fern, Palace, Percom, and it is only a question of accessing that data. That is done through a report or reports that comes off your system. That report is then saved, password protected, with, as the Data Protection Commissioner requires or recommends, a key of not less than 12 characters. And for added security, because that particular file is then sent by email to me to prepare this particular workbook, all references to the name, address, telephone numbers, etc. of individual members are removed. So in effect, it is a quite secure transfer, and then that same password is utilized to return this particular workbook to you to conduct phases, what we call phases 2 and 3. Phase 1 is the extraction of the information and the preparation of the report templates, etc. What you actually get is a workbook that contains these 5 tabs, the colored ones, and we'll take a look at each of those in turn. The main worksheet is the data that has been extracted from your system, and that appears in the columns where row 1 is colored green. It does go on and on a bit, and the orange colored tabs are calculations based on the data that has come off your system. In phase 2, your credit union, probably your credit controller or his or her staff, will enter various indicators for some of those items that I mentioned earlier, such as the short-term arrangements, shared loan transfers, solicitor referrals, etc. And in addition, will pick up where it's not picked up off the data from your system, uh, connected accounts and guaranteed accounts with the connected numbers. In phase 3, I should point out that between phases 1 and 2, you will probably look after between 70 and 90% of your loans. And I will show you how that will be reported to you just in a second. So that phase 3 will be left with those loans that have not as yet been reviewed, and again they will be reviewed on a risk basis, and I'll explain that to you as we go through the reports. So what we actually get, as I say, after phase 1 in particular, we will get a report on all of the loans that have been reviewed, and they're reviewed under these review categories. The straightforward ones, loans within shares and loans within shares within arrears, loans with repayments in advice, and loans up to date. So they're all the easy ones, we could call it that. Then we have the loans in arrears, but where there are regular repayments, and regular repayments means a minimum of 80% by number and value of what was meant to be repaid in the period. And then we have the loans, and I refer back again to Res 49 and any override provision that is entered on your system, and these are the loans that are already fully provided. So it gives us a total of what has been reviewed, and then it'll tell us how many remain to be reviewed and the value of those loans. And that again is produced in a little report here. And this, incidentally, is based on an Octagon system, and this is the second or third quarter that it's being done, so that there were loans reviewed in the previous quarter, and where they have not fallen into those categories I just mentioned before, the remainder with the original notes are left, and again these can be looked over. But the bottom line is that we would hope to look at least these 78 loans in phase 3 that amount to 10% in value of the loans. And if we get through all of that, we're going to have reviewed about 92% of the loans by number, and we'll have 95-96% of loans by value. We can then move on to look at the medium risk and so on. And the target would probably be that over a year you'd like to see 100% reviewed. There is an item called auto mitigation, which kicks in when this particular system, based on this workbook, is calculating its own provision, where again it looks at people who have paid regularly and will in certain circumstances reduce the risk scoring that has been applied. The credit union can switch that on or off as they wish. When all of the items have been reviewed and this system has calculated a provision, it then looks at the resolution 49 plus any override provision, and where that's what I call your credit union system provision, and where that system provision is greater than calculated by this system, then that is the figure that will stay. It's your credit union figure will be the one. Where, however, this system has calculated a higher figure, then an additional provision, the difference between what is calculated here and what's on your system, will be provided. There are then a series of reports that the first of which is resolution 49, which is standard, and it's also a trigger to ensure that everybody is singing off the same hymn sheet. So it's the first thing that's looked at after phase 1 is completed, and it's sent back to your credit union to ensure that the figures in this Resolution 49 are the same as the Resolution 49 that's coming off your own system. We also put in the balance sheet figure for the provision for bad debts, and that in turn enables us in the summary, and particularly for the board, to compare that provision in a number of ways as specified in this summary report, and indicates in most cases the amount that of over provision that exists. Now, nothing wrong with over provisions per se, but it's good to be able to at least quantify them. This final one down here, in actual fact, is what I call the ultra prudent one, where we compare the provision in your balance sheet with the total of the net loans in arrears greater than 9 weeks. That's the amount at risk. And then we add a further 10% and we compare that, and even that shows that we have an over provision. The system also just calculates the PERLS ratios based on the figures provided. Management should get quite a scene out of this particular report because of the way it's laid out. The loans are fair enough, gross attached shares, net loan, percentage of the net loans in each category, the ratio of shares to loan, and there's your provision that's in your system, and the additional provision that is calculated by this system. That then gives us a total, which we again calculate as to what percentage that is of the total provision, and then what percentage it is of the net loans in that category. And as one would expect, it is those with the higher number of weeks in arrears will attract the highest percentage in this particular section. But we do it in a whole variety of ways, whether it be by category. This used to be used by the field officers, by purpose, by the date of issue, which again can be a very good guide for indicating some action that was taken and the results of it. And I happen to know that this example, the credit union that it's based on, joined ICB in or about July 2012, and you can see the effect that that is having. We analyze it where the information is available by the age of the members, and sometimes it can be quite surprising as to the percentage of the provisioning in the age group that is attracting the biggest percentage. Ditto, where available, we do it by the number of loans, by the length of membership, by the projected completion date, which is a good one for cash flow purposes, by interest rate, where there's 2 or more, at which also shows us the average, and again one that doesn't actually total the same as all the rest, but it shows all of the loans in the various Res 49 categories that have been fully written off. And this one indicates that there are 11 loans where there have been no capital repayments in greater than 52 weeks, and which in theory should be written off. The final one is by regulatory requirements, and this one unfortunately is a variable feast because the central bank are inclined to change it year on year. But again, dependent on the information that we have, we should be able to fulfill most of the criteria for you. And that is a brief overview of what this particular system can do. The cost is not unreasonable, I think you'll find, and cost comes in 2 ways. It comes in money and it comes in time, and based on experience it is reckoned that it should take approximately 3 hours per 1,000 loans per quarter to do the review, and I think you'll find that that's an awful lot less time than what you've been spending already. Thank you for your attention, and I would be delighted to talk to you about your requirements.